All right, welcome to Building a Budget. We have our very own Score Boston volunteer, Michael Sandman, on today's presentation. But as we get started, we want to make sure that you are taking advantage of all the things that Score offers that are there for you for free. So our goal is to share small business information or to provide education. We do that in several different ways. One is through the website, score.org. You're going to find podcasts, blogs, other recorded workshops, articles, templates that you can download for budgets, cash flow, financials, other financial topics, business plans, marketing plans, lots of really great information. So if you haven't dug around on the SCORE website, take a look. The other way is through our workshops and webinars. We advertise those through social media, through our newsletter, and they are also listed on the website. So take a look for to see what's coming up next. I think the most important thing that we do, however, is the mentoring. Our mentors are volunteers, and they have come to us with a variety of different skill sets and experiences that they've learned from that will share with you. We work with folks at all levels of the spectrum, whether it's you're trying to decide if you should start a small business, to planning for it, to being in business, to growing that business and exiting that business. We're there with you the whole journey. So, a beginning session, a mentor is going to want to learn about you, what your goals are, what your challenges are, and they're going to work with you to come up with a plan so that you can keep moving forward and be successful. It's not uncommon that other mentors are brought in to co-mentor, or you're referred to other mentors as your needs change and you need other skill sets. So we freely work as a group to make sure that you have what you need. So the next logical question is, how do I get a mentor? There are multiple ways on the score.org website to get a mentor. I think the easiest is to let us do the matching for you. Just put your zip code in. That will put you to the chapter that's nearest you. There's a little quick form. We want to know like I said, what your goals are currently, how a mentor can help you in this moment, and what your business is. And we'll use that information to match you to the most appropriate mentor. So as we move forward, I do like using Q&A. It allows me to keep track of questions a little bit easier. So if you have any questions for Mike along the way, please put them into Q&A, and I will make sure that they get answered, or as many questions as we can get answered. We are recording, and that recording will be posted on the score.org/Boston website. As you can see from the graphic, just look under the local workshops pull down on the blue bar for the previously recorded. Give me 24 to 48 hours to get it posted, because it doesn't quite happen right away, but we will get that up as soon as possible. So that's all I have to share. So I'm going to go ahead and turn it over to our presenter. It's all yours, Mike.
Okay, thanks very much. Let me share my screen here and get to work. There we go. Okay, um, so this is building a startup budget, and we're going to go through how to figure out how much money you need in order to start a business, how to figure out the likely flow of revenue, sales that you achieve, uh, and how to manage to make sure that you have enough cash as you're starting up, so that the business can get to the point where it's self-sustaining. And we'll go through a series of Excel spreadsheets, and we'll be sending the spreadsheet template out to you so that you can use it for yourself. And a copy of the webinar itself will be available online, of course. And I think Teresa will be sending out the PDF of this. Is that correct, or a link to it?
Well, well, they can watch the recording again. Yeah,
Okay,
and
we'll
we'll
send
send
them.
we'll send the important parts.
All right, great.
Yeah.
Okay. Okay, let's start with some definitions. Revenue or sales is what the customers or the clients pay. Net revenue or sales is what's left after any returns or allowances, discounts, anything of that sort. Sometimes people confuse sales with uh, profit at the end, which is what's left over at the end of the day, the end of the year. But revenue is and or sales pretty much interchangeable. Is what is the amount of money that comes in the door. It's not the amount of money that you have left over at the end. There's expenses or costs get deducted from that. So the expenses or costs are what you pay to run the business. And there are three kinds of costs or expenses that we need to think about. There are startup costs, equipment, build out, website, legal costs, whatever it is that's necessary to get the business off the ground. And then there are some fixed expenses. You may have rent if you have a brick and mortar business, web hosting, insurance, telephone, that sort of thing. They're called fixed expenses because they continue whether the revenue goes up or down. And variable expenses are labor, including your labor. That's really important. You want to make sure that you include as an expense in your projections your own labor, because if you don't do that, there won't be a provision for taking money out for yourself. Parts and supplies, inventory, they're called variable expenses because they tend to go up and down depending on revenue, with the exception of your labor, because you're doing this work. You're not necessarily paying somebody else if you don't need someone else, but you're doing it, presumably at least half time, maybe full time. Profit is what's left over after all the expenses are paid. So after in the first sort of period when you're doing your work, the startup costs will be a big hit. That's normally a substantial amount of money, and then fixed expenses and variable expenses month by month will give you hopefully some leftover cash at the end, and that's your profit. Okay. So why do we bother with doing this startup or ongoing budget projection, which we're going to work through? Well, it will help you figure out whether a business will enable you to reach your personal income goals. And that's really important. If you're starting a business or you're running one, you're presumably not going to have the time to have a second job somewhere, or if you are, if you do have that, you're not going to be able to pay all that much attention to it. You're going to have to work in the business itself. You want the business to be able to replace the income that you may be getting from a job. And you have to figure out how much money you'll need to start up or expand. Um, this will help you gain an understanding of the risks and the rewards. The rewards, presumably the amount of profit that you have at the end, and the amount of profit that you have on an ongoing basis. It'll help you identify the development and startup costs and the ongoing expenses in those three categories: the startup cost, the fixed, and the variable expenses. And it gives somebody who lends you some money or gives you some money, whether they're family, a nonprofit lender, or a bank, the information that they are going to require before they'll sign a check and give you some money. If it's a nonprofit lender or a bank, the thing they're most concerned about is getting their money back at the end. Can you pay off the loan? And they'll typically be asking you for the kinds of documents that we're going to be producing through this webinar. And finally, they provide a plan to help guide your decisions and monitor your results. So if you make some assumptions about how much revenue you're going to have month by month, you put it down on paper or in this Excel file, virtual paper, uh, you will be able to look back on it and say, well, how am I doing? And do I need to make some adjustments in my assumptions? Do I want to continue to do what I'm doing here, or is there something else that I may need to do in order to fix the business in order to get the results that I need? So this is a guide for you as well as a guide for somebody who is providing money for you or money to you. Um, so we're going to walk through a number of spreadsheets that are all part of a financial projections template. They look a little complicated. You may think, I can't do this on my own. I don't understand all the figures and the math. It's overwhelming. Um, can I do this without a financial projection model? Well, yeah, but you run a very substantial risk of not knowing what you're getting into. So we've broken this up into pieces that I think will be relatively bite-sized, and go through it. And then as you begin to think about doing this for yourselves, talk to a SCORE mentor. You can find a mentor through all of the mechanisms that all of the websites that we have for SCORE chapters in this part of the country, and you can enter your zip code, and SCORE will match you up with a mentor somewhere close to you. So you can get some help with this. Specifically, ask for help with the financial projection model, and someone who understands how to do this will work with you to put it all together. So you really can do this, and mentors really will be happy to help you. Okay, so the example we're going to use is a tree nursery. And we're going to do that because a tree nursery is a little bit more complicated than some other businesses. So we've got sort of all the bells and whistles here of financial projections in this thing. And there are businesses that are simpler to start up. A storefront might be a little bit simpler because if you're starting in the storefront, bricks and mortar business, you don't have to buy property. You probably have to rent it, but that's a simpler process than and simpler to finance than what you have to do with a tree nursery, for example, where you need some land in order to grow the trees. And so she's going to be producing specimen trees, shrubs, and vines. She's looking to sell, her objective is to sell about $700,000 in her third year. She recognizes it's going to take some time to go from 0 to 700,000. And she sells to florists and consumers and perhaps some landscapers as well. Um, and it's important to recognize that she is going to go from 0, that's where she starts, and she's not going to get instantaneously to $700,000 a year worth of sales. It's going to take time, month by month, to build up those sales. And we'll go through an example of how to project that, because it's a very typical need to project how quickly you're going to be able to bring in dollars and cents, how quickly your sales will take off. And it depends on what kind of business that you're in, what kind of business you're in, as to how that will work. But we'll show you how to think about it. Okay, and so we're going to go through 6 worksheets. We're going to go through the startup funds that she needs in order to get going. Every business has some kind of startup expense. And then we'll talk about salaries and wages, what she pays herself and what she is going to have to pay for employees as they come on. We're going to talk about her fixed operating expenses, the expenses that go month to month, and we'll talk about variable expenses as well, uh, and projected sales forecast, and we've got a couple of spreadsheets to go through that. And finally, cash flow, and talk about cash receipts and disbursements, and help figure out how much money she's going to have at the end of each month as she goes through the process of starting up in her first year. The templates will work in Excel, in Google Sheets, in Apple Numbers. So whatever spreadsheet tool you have, the template, you should be able to open up the template and work with it. Okay, startup funds, in this case for a plant nursery. And as I say, this is a little bit more complicated business than some. She has to buy some land. She could lease the land, of course, but in this case, she's allocated $100,000 to buy some land out past the suburban area, out in the place where she can get land relatively inexpensively. She's going to need a building, perhaps a work shed or something of that sort, or something a little bit more elaborate than that for her land. She's going to make some improvements uh, in that building if she's renting a facility somewhere, which she might need to do. She needs some equipment, some furniture and fixtures, a desk, a computer, some things, and a delivery vehicle. And I don't know if the numbers are exactly right for the kind of business that she's doing, but they're good examples. And the point that I want to make is, just to get started, she needs to spend $172,000 on fixed assets, on the things that are going to last for more than a year. They're not just quick expenses that are one time and go out the door. She's also going to need some money to get the business going besides buying the land, besides getting the equipment and so forth. And those are sort of the pre-opening salaries and wages. And for the moment, we're going to say she doesn't need anything for that. She's not going to hire anybody in that interim period. She's doing her own planning. She's got a job or she's got income from some other direction. So okay, we'll leave the pre-opening salaries and wages blank. That's a matter of judgment as to whether you feel you need to hire somebody to help you out, and are going to have to pay them ahead of time. She has some prepaid insurance premiums for her liability insurance, property insurance. She has to get some inventory in place, and that is going to be inventory that she goes out and buys instead of growing it. Uh, and she'll have some legal and accounting fees. You can see the rest of it there. And so she needs about $41,800 in operating capital in cash in the bank beyond the cost of those fixed assets. So altogether, she needs $213,800. And that's to get the business going, get it off the ground. And she doesn't need that every month. She needs that once in order to get it started. Every type of business will have a different group of startup expenses. So you have to think about the kind of business that you're starting. The ideal situation is for you to have worked in that business or in something very much like it for a while so that you know what the startup expenses would be. But we'll talk a little bit later on about how to find information about what those expenses are, how to find information about what your costs are likely to be going forward. So how much do you need? Where will it come from? And what is it going to be used for? And be sure to include starting inventory and labor costs if those are factors. If you're paying a salary, you have to remember taxes and benefits before you make the first sale. All of this is before that first sale, before she opens her doors and begins to ship plants to florists and customers and consumers. So again, each type of business requires its own sort of profile of startup expenses. This is more or less what she'll require. Okay, uh, this is an accounting detail. To some people, this won't matter very much if you don't have to invest in fixed assets in your business. But in her situation, she is investing in these assets. She can reduce her future tax liability by taking a portion of the cost of those fixed assets each year and reducing it from her profit. She carries it as an expense. So she is spending $172,000 on fixed assets. That money isn't a loss on her profit and loss statement for the first year. It's a portion of it is. It's only the portion that has gone down in value through use, through wear and tear, and so forth in that first year. So real estate and buildings are depreciated using IRS rules over 20 years, leasehold improvements over 7, equipment in many cases over 7 years, and so forth. The Internal Revenue Service publishes a schedule of these things. Land is not depreciated. The assumption is that land has value that does not go down. There's no wear and tear on the land. It's something that you don't need to worry about unless you have some substantial fixed assets that you're going to need to invest in. And in that case, you'd probably need to talk to an accountant about how this is going to work on your profit and loss statement and on your tax return. I mention it for those of you who have that situation, who have substantial fixed assets. You have to understand how this is going to work. And this is not an accounting workshop. Um, it's a cash projection and sales projection workshop. So I'm going to leave it to you to find an accountant to talk with. SCORE has a list of accountants we can refer you to if you need to get some more information about how this works. The operating capital side of what she needs, the cash piece, that 41,000 was it $41,000 dollars and some change. Uh, that goes for insurance premiums, inventory, and so forth. That's money that she's going to spend once and it's gone. It's not depreciated. Those things don't last for a year. At least we hope she doesn't hang on to inventory for a year. And so that's cash that she needs to write a check for and doesn't have to worry about depreciation on it. Okay, let's talk about operating expenses now, both fixed and variable. So fixed expenses, advertising, car and truck expenses for that delivery van, insurance, legal and professional services. These are things that she's going to pay for month by basically every month. Doesn't matter how much money is coming in the door or if no money is coming in the door. These are expenses that go on every month. And it's really important to remember that fixed expenses do continue without regard to how much in the way of sales that you have. Variable expenses will go up and down depending on sales, and we'll look at that in just a minute. But these expenses continue right through the whole year and into future years, unless she grows and perhaps the expense line will change a little bit, or she adds some other uh, element of fixed expense. Okay, now we're going to talk about the revenue side, the sales, the money that comes in through sales. She has three categories of sales. She's selling direct to local retailers. She's selling through representatives who get a commission to distant retailers. And she has a website selling um, flowers, plants online to end consumers. And there are, if you're a gardener, you know that there are some businesses that do very well with this sort of thing. They have catalogs of flowers, and they have a website, and consumers can get these things shipped to them. Typically, um, uh, uh, tulip bulbs and things of that sort, but also some live plants. Um, with all of these categories, it takes time to get that first sale and more time to build sales volume. And when you're thinking about revenue, thinking about the money that's going to come into the business, be realistic about how fast that's going to happen. How soon will people know about you? How soon will they begin to spend money on your product or service? So, where do I find out about this? Well, if you've worked in the industry, you'll have some sense of it, but ask people who work in the same sort of business. If they're dealing directly with consumers, the same sort of people as you are, how long did it take them to get their sales going on their websites, and what did they do to that website in order to make it attractive? Um, and you need to build a month by month sales projection rather than just think about, well, what am I going to have at the end of the year? Because it will vary. It will presumably go up slowly month by month, and then perhaps level off as you get into your second or your third year. But asking people who work in the same sort of business is a really good way to do it. Working in it yourself, in that business yourself, is an even better way to understand how sales volume gets built up. Um, and then think about, well, we have these categories we have these three different categories. Are you selling products? Are you selling services? Are you selling services by the hour or on a fixed price contract, or maybe a combination of both? Figure out what makes up your unit of sale and determine your cost of goods sold for a unit. And again, we're going to go through that a little bit. And then from that, think about what your price per unit needs to be in order to give you a profit. And that price needs to be realistic. It can't be much higher than the market price, than what other people are charging and what consumers and customers are willing to pay. But it should be grounded in reality. It should be grounded in the reality of what your costs are. So again, we'll take a look at all of that. Okay, sales forecast. So this is what Ann is expecting to do in with pallets of plants, and she's expecting to sell 125 pallets. That's her projection for the year. They cost $2,000 a piece. There are a lot of plants on that pallet. And so she's expecting to sell $250,000 of this type of product. Uh, Her cost of goods sold, what does it cost her to produce that product, to get it onto the pallet, to ship it out, to package it, whatever she's doing? She's figuring that it's going to cost her $137,500 to do that. And so her margin, her gross margin is $112,500. That's not her profit. That's um, the cost of goods sold less the revenue that's come in. Okay, so that's really important. That's the sort of an intermediate margin. So if you have a product, uh, you need to figure out what that cost of goods sold is likely to be in order to do a proper projection as to what your price needs to be, and in order to figure out whether you're going to make a profit out of it. But as we'll see, she doesn't start off selling um, 10 pallets a month. She's going to start off slowly, and so that sales is going to build up over the course of a year. Okay, so each product line has its own cost, its own margin and seasonality. And I realize this is uh, there are a lot of numbers on this spreadsheet, so we're going to go through it carefully. So again, she has the plant pallets, $2,000 for a pallet of plants. She has a plant mix that she's going to sell bags of perhaps bags of bulbs, tulip bulbs or something of that sort. And she's going to charge $100, and her cost for getting those bulbs, whether she's growing them herself or buying them from someone else, is $60. Her plant mix for distant nurseries, she's going to be selling um, larger bags and $1,000 a piece, and she's expecting the cost of that will be $600. So there's a little bit of difference in percentage cost of goods sold for each one of these products, but her margin per unit, you can see right here, varies from $900 to $40 to $400 depending on what she's selling. So if you have different kinds of products or different kinds of services, you really have to work this out for each type, each broad category, and ideally for each individual product in the in your mix, because you have to set a price somehow. Okay, let's take a let's see if we can look at this. Just one second here. I'm going to make this a little bigger if I can. Yeah, let's go here. Maybe a little bit bigger than that. No, that's about as big as that's going to get. All right. Uh, okay. Uh, so you remember I said things start off slowly and eventually they get there. So here she's projecting that she's going to sell her plant mix. This should actually say pallets, not bags. Uh, she's going to start off 5 in the first month and 5 in the second month, and then it begins to build up in April to 10 and 20 in May and 20 in June. And she figures that by July, people will have done their planting, their spring and summer planting, and so things will drop off pretty sharply. And then in August, they may pick up again for, remember, she's selling to florists and landscapers, pick up sharply for fall planting and tail off for October, and then back to almost nothing in December. Total of 125, but notice the curve. Notice the pattern that she has. Whatever you're doing, if there's a seasonal pattern to it, you have to think about that. And then there's also the question of, well, when she's first starting up, what is she going to be able to sell? And she should be figuring that as a pretty low number. And so there's the sales dollars, okay? And it's $250,000 by the end of the year. But in the first 4 months, it's only $50,000 out of that 250, and a third of the year has gone by. And so here's the cost of goods sold and her margin, and you can see that the margin builds up, and that then peaks and takes that same dip in July and goes out through the end of the year. Um, for her plant mix that she's selling on the web, typically to consumers, it's a bag. And it's going to take her a while to get some people to come to her website. And then she's hoping that she'll get started in a pretty big way in May, and she'll have $5,000 worth of bags sold. But then things slow down a bit in the summer as people have done their spring planting, and hopefully she'll pick up again in the fall to some substantial amount, 100 in September, October, November, and she'll end up with $57,000 worth of sales of this class of product. And from that, she'll have $22,800 left over to pay all of her other expenses, along with that 112,500 and the money that will be left over from selling to distant customers using representatives. So how long will it take there? She's got to line up her representatives. She's got to get them going so that they begin to sell. And she figures she won't see any money at all from that until September, October, November. And then December, things will drop off again. And so she's got $16,000 for this year, this first year coming out of that product. Now, going forward, the next year, she would expect to have a much higher number because she's had this first, 4 months, 8 months with nothing at all. So this is a pretty realistic set of examples for different kinds of products, different kinds of customers, and you have to think about where you fit. So is your product likely to take off at the very beginning? Is there a seasonal factor to it? How quickly can you get there if you're selling on the web? How fast can you attract people to your website if you're selling via a store? How do you get people in the door in that store? If you are selling a service, what's the selling cycle for that service? If you're a consultant selling substantially, tens of thousands of projects worth tens of thousands of dollars, there may be a selling cycle that could be months long. So how long will it take to get that first dollar in for each of the products or services that you have? That's a question you have to answer for yourself. Again, we've talked about where to get some of those answers, perhaps by having worked in the industry or talking to people who are working there now or have had experience. So, okay, let's total all of this up. So in January, she only has $10,000 worth of sales, and her cost of goods is sold is $5,500. She has $4,500 of margin left over to pay all of her other expenses, and we'll see what that means to her in a couple of more slides here. When you get to June, she'll have total sales of $42,000 she expects, and she'll have $18,800 to cover all of her sales. All of her expenses. So obviously a lot more money. And you would expect that in all probability in those first few months, she's going to be losing money because she doesn't have the enough margin coming in to cover her fixed expenses until it begins to pick up in April, and then in May and June, it's something really begins to take off. The end of the year, she's got $347,000 worth of sales. That's her expectation. Remember, she expects to sell in her third year $700,000 worth of product, or $710,000 worth of product, we've said. The first year is only half of that. And again, is that realistic? Well, probably, depending on the kind of business she's in. And you have to think about that and decide for yourself what your likely first year sales curve is going to be. Okay, now we're going to talk a little bit about, I said, working in the industry is a good thing. Talking to people is helpful. Let's talk about where we're going to get some of this information, because you need to know what these costs are. You need to have some sense of what the sales curve will look like, how fast your business will take off. So You get unit costs and price from suppliers. You can learn from competitors if you talk to uh, competitors I mean, most of you are, if you're thinking about um, uh, a business in which there are lots of local competitors, go outside the locality and go 50 miles away and talk to somebody who's running the same sort of business as you are, who you're not going to compete with, or 25 miles away, or maybe 5 blocks away. Um, and ask them, how long did it take you to get started? What kinds of price, where do you get your pricing information, and so forth. Uh, Work in the industry is, we always tell people that that's a really good idea. If you can work in the industry, you learn so much, and you don't have to work there for terribly long, or be the boss in an organization. You just have to keep your eyes open in the business that you're working in. You can get estimates from financial news reports. You can observe competitors. How big is the property that they've rented, or what does their website look like? Join a, and how do they seem to be selling? Join a trade association. So just about every product and service you can think of, there's a trade association. There'll be trade associations of tree nurseries, and trade associations of florists, and trade associations of consultants, and trade associations of just everybody, every kind of industry you can think of. It's worthwhile doing that because you'll get to meet other people who are doing the same thing as you are, and uh, you'll get some information from them. There'll be workshops that the trade association will run. They usually run conferences and so forth, um, and that can be very, very helpful. Estimate the sales volume you need to make the business profitable. How much do you have to sell? And then think about, well, can I do that? Is that realistic? And remember, the profit is after paying you yourself. You have to be sure that you're going to get enough income out of it to live on as you're building this business up. And finally, there's the Kirstein section of the Boston Public Library. It's in the new part of the Boston Public Library that faces Boylston Street downtown. If you go in and you go downstairs, there's a section. There's a group of reference librarians who work in a section that is focused on helping business people. So there are reference librarians there who can look up information for you on, well, what are the trade associations, um, what kinds of articles have been published, what kinds of magazines are there, online publications, and so forth for this industry. It's a very, very helpful service, and it's free. It's free for the price of the parking meter on Boylston Street. So it's best to go in there. SCORE has mentors who have office hours at Kirstein. So you can actually you can sort of kill two birds with one stone. You can talk to a reference librarian and see a mentor at the for the same visit. It's a really useful resource. But again, so are these other things. Joining a trade association and working in the industry are just really useful ways to learn to answer all of these questions that we're asking. How fast do things build up? How fast do sales build up? How do you attract customers? What are the costs likely to be? Okay. Another thing that you need to think about, depending on the kind of industry that you're in, is, well, how fast will your customers pay you, and how fast do you have to pay your bills? So there are some businesses where if you're um, selling using credit cards, the customer gives you a credit card number, you get your money almost instantly, and you don't have to worry about this. And there are other businesses where the customer will send you a check after you've sent them a bill, or they make a payment of some sort, perhaps with a credit card after you've sent them a bill, and there's a lag time. There might be 30 days, 60 days before they send that payment in. So you have to again find out what the typical process is in your industry. How fast does money come in the door? And similarly, how fast do you have to pay your bills? So you may have to pay with a credit card, in which case you've got to have the cash available perhaps before you get it from your customers, or you may be able to get credit from a supplier and pay in 30 days or 60 days, something of that sort. Um, Again, it's industry dependent. You can learn about this by talking to people in the business, particularly talking to suppliers. They'll tell you what the chances are, what their requirements are for your paying them, whether they'll give you credit right at the beginning of your work. But if you have that spread, if you have this is a typical thing to work out. If you are thinking about that cash coming in the door, if it's not coming in the door right away, then you have to say, well, okay, I need a little bit more cash earlier in order to finance the purchases that I'm going to make, unless I can get credit. So let me make sure that that's understood. If you're if you have to wait for your customers to pay you, and you have to pay your suppliers right away, you're going to need additional cash, the amount of money that those suppliers are going to expect from you, um, before your customers pay you for it. It's one of those capital expenses that you need right at startup, or operating capital expenses that you need right at startup. Okay. Um, Sources of funding. Where is Ann going to get the money? Where are you going to get your money? So let's look at what she's done. She has she's going to take a home equity line on her home, and she's going to raise almost a little bit more than half of the money, $115,000 from that. And you remember we said down here she needs $213,800 in total in order to get this off the ground, between her fixed expenses for capital and the money that she needs in the bank in order to make this work, so that she can buy supplies and so forth, and pay herself. And so she's going to get a commercial loan. And how does she get a commercial loan? Well, she's put in some money. She has some collateral in there, and she's got some land. And so she can get a mortgage on the land, and she's going to get a vehicle loan for that van, that used van that she's going to buy. And so that adds up to $213,800 to match the amount of money that she knows that she needs. So she's fully funded at that point. You have to work this out for yourselves. Uh, do you have some equity, owner's equity, or some cash in the bank that you can put into this? Um, can you get a loan? Can you get a loan from family? Can you get a gift from family members? Where are you going to get the money? It's really important to match up the amount of money that you can see yourself getting with the amount of money that you saw that you need in order to get the business off the ground. So remember, she saw that she needed $213,800 way back here. At the beginning. Okay, so she saw that she needed that to start the business without being reasonably sure that you're going to be able to find that much money is a mistake. You really don't want to do that. So that's where she's going to get her funding. Where are we here? There we go. She knows where she's going to get her funding. You have to know the same thing. If you have an existing business, you can calculate the cash that you have on hand. You have a pizza place and you want to open another one. How much money do you have available in the ongoing business? And so that will help you figure out um, how much you have in addition to what you might be able to borrow or get from your own home equity or something of that sort, in order to get that capital for that second pizza parlor. Okay, now we're going to go into cash flow projection that puts all of this stuff together. And it's 3 slides, three spreadsheets, and we're going to go through them one by one, but I think you'll see how they link back to the earlier spreadsheet. This is kind of a roll-up of the whole thing that we've been talking about, the sources of funding, the cash that she needs to get off the ground, the sales projection, the expenses, everything all put together in one great big, slightly ugly, but nonetheless very important and I think very useful projection of cash flow. Okay, cash flow. So you remember that she has cash receipts, that is money coming in the door from that sales projection. So you remember that she started off with $10,000 in January of the pallets of plants. And then by May, she was beginning to sell on her website. And by September, she was beginning to get her representatives to sell some product for her. But that's her sales. And we said it was $347,000 of money coming in the door. And we're going to assume that it comes in, that she gets paid in the same month as the product goes out the door. So um, she started off with $41,800 in the bank. Where did that come from? Okay, let's go back and have another look. It's here. We said she needed to have $41,800 of operating capital, of cash on hand in order to get started. Okay. And here it is, right at the beginning. Cash on hand at the beginning of the month. In the first month, she's got some labor herself. She's got her owner and management. She's drawing $7,800 a month out of this. She's got real estate. Employment taxes and employment insurance. Her payroll and taxes all by itself is $13,500, and she only had $10,000 come in. Okay. Fortunately, she had that $41,800 in the bank when she started, so she had almost $52,000 to work with. That payroll and taxes goes on uh, right across the year, and we've left that labor line level. As a practical matter, it probably should go up because she'll need some more people. Okay, so you can see that at the beginning, she's actually her bank balance actually begins to go down. It begins to go down all the way down to $15,000 by April because she doesn't have much in the way of sales over here. But she does have her ongoing expenses. Next, let's look at those operating expenses. Here they are. Figured that the fixed expenses were running out at $4,300 a month. Continues month by month, doesn't matter what her sales are. And then she has some other expenses. She has depreciation. Well, we're not going to calculate that for her until the end of the year. We'll let her accountant do that. But she's paying down her commercial loan and the mortgage and the vehicle loans. And she's paying interest on a line of credit from the bank that she's borrowed some money from. So she's got these expenses, and they rise slowly through the year from $700 a month to $1,300. And so when you total up all of her expenses, the $13,000 and some change for payroll, the $4,300 from the fixed expenses of operating her business, and the other expenses that she's got. In the first month, she's got $18,511 worth of expenses, and she started off with $51,000 of cash, leaves her only $33,000 of cash at the end. That $33,000 carries back to the top of that first spreadsheet. Here it is, 33,290. And the spreadsheet is put together so it'll do this for you automatically. The template will do this. It will look back and say, well, okay, what's the end of January number? That's my beginning February number. And the same thing is going to happen in February. She's got $18,000 worth of expenses, and she started with $32,000 worth of cash. Some money came in from sales, $10,000. So she's got She's down to 24,676, and that continues down to where her low point is in April. She has $17,000 left in the bank at that point because she's been spending that $18,000 a month right along, but bringing in only $10,000 or so of revenue. Okay. In May, things begin to pick up, and she go back to the sales, and you can see that her cash receipts begin to grow. They actually start a bit up in April and May. They get to $45,000, $42,000 in June. So that when you go back down to the bottom of this thing, there's money left over. Okay, and it begins to build up. And if we put some more labor cost in here, it wouldn't build up quite as fast or quite as high, but she has a substantial amount of cash at the end of the year because she's been making a profit for those last several months. Okay. The first few months, there was no profit. There was only money going out the door. And she had to have the money in hand before she started the business to be sure that she could cover that out the door expense until sales started to pick up and she could see a positive cash flow. Okay. The cash flow puts all of this stuff together. And uh, if you want to get some help building a cash flow, there are SCORE mentors who'll be very happy to help you do that. It's really important to do it because it will give you a picture of what you need in order to get through your startup period. The startup period for any business, I don't really care what it is, any business has startup expenses that exceed the revenue right at the beginning. Or almost any business. Really hard to think of one that doesn't work that way. So make sure that you have figured out what you need ahead of time using this whole process that we've gone through. Okay, so why bother with doing all of this stuff? You have to figure out whether the business is going to enable you to reach your personal income goals. She's taking $7,800 a month out to cover groceries and cover her personal family expenses. And she'll also take some money out at the end of the year from all of that cash that's accumulated. And uh, that will presumably after the first year and certainly after the second and third, she'll be able to reach her personal income goal. How much money do you need to start? We've gone through that, how Ann figured that out and where it came from. And she was able to use that projection to give a bank the information that they need in order to say, well, okay, she knows what she's doing. She's done her projections. Um, and we're pretty comfortable giving her this money because we're pretty comfortable she can pay it back. You get in a sense of the financial risks and rewards. Well, how much cash am I going to have? How much profit am I going to have at the end of the year? By the way, I still have to pay taxes on that profit, but how much am I going to have at the end of the year? And what are the risks? How much cash am I going to, or capital of my own, am I going to have to put into this business? It shows you your startup costs, your development costs, your ongoing expenses, and it really provides a guide because month by month, she should be looking at that great big spreadsheet, this one here, um, and seeing where she is. How am I doing? That's the question she should be asking herself. So, speaking of questions, let's go to some questions. Teresa, where are we on the
Great.
questions?
I do have questions. Is there a margin of error that you should use into your startup budget so that you're not overly optimistic about the sales, or
Yeah,
how do you?
that's a good question. So on the expense side, assuming that you have a pretty good idea of what you're getting into, you might have a 10% margin, and you might be a little bit cautious in the first few months in terms of revenue and sort of build in maybe a 10 or 20% margin. Um, but it really depends on how much you know, if how certain you are. If you're really completely uncertain, then you probably shouldn't be doing this until you get some more certainty. But I would say that it's not a bad idea to build some contingencies in, especially on the expense side.
Okay. And then I have a couple questions that are a little bit outside of today's topic. So I do want to start off with saying that this is part of the Business Essentials series. There's 12 topics in this series. So some of these are going to go into more depth in the future. For example, I have a question for you, Mike, here in a second that's about pricing. And we do have a webinar that's specifically about pricing and it'll run in mid-June. So definitely watch out for this, but maybe Mike, maybe you can just give a couple quick comments.
Sure.
Do you recommend cost plus or market-based pricing when you set up your selling price?
Well, hopefully, if you do cost plus to give yourself an adequate margin and the market price, they should meet or come pretty close to meet. Um, Figure out cost plus. That's what this is all about. This all of this stuff gives you the cost plus the cost. You see the cost of goods sold, all of the other costs, and at the end of the year, there's a profit. Okay, so that's good. But then, is that $2,000 for a pallet of plants? Is that realistic in the market? If it's um, if it's significantly higher and you can't and there's no particular reason for a customer to come to you because you have better plants or a better reputation or your delivery is faster or something of that sort, um, then then in all probability you need to figure out a way to lower your costs. Uh, but do this work first and then think about what the market or learn about what the market price is and look for a reasonable match between the two.
How can you estimate advertising costs in the first year? Are there any models for that?
Um, Good question. Um, it depends on where you're advertising. Are there models for it? So every business is going to advertise somewhat differently. There'll be some print advertising for some kinds of businesses, some web advertising. You have a website. You may have ads on, may put ads on Facebook or on uh, Google or someplace else that carries ads. Instagram. There are all sorts of places to put ads. They each have their own profile for charging and how you set up your ads and so forth. Um, the best thing to do is to look at what other companies in the same business are doing and then go to the medium that is providing that platform for the ad, whether it's Google or somebody else, Facebook, whoever, and talk to them about what the ad costs and emulate, copy, not copy the ads, but copy the process that other people are using, assuming that you think that that looks pretty good. Um, if you think you've got a better idea, then okay, you can certainly pursue that. But look at what others are doing and build a pattern initially, at least off of that.
Okay. Yeah, and we do definitely run marketing, digital marketing, social media workshops as well. There's some in the previously recorded, and there'll be some of those coming up as well. So I do have another question. I'm not sure if you're going to be able to answer, but if a startup with a product obtains a letter of intent from a client, will the bank extend credit based on it? Or what should
Oh,
you do to,
that's a really interesting one. So if you have a letter of intent from the client, there's a possibility that you can get funding for that. Um, if you have had experience delivering that product or service and the bank is pretty comfortable that you'll be able to do it, and if the letter of intent is from an organization that is reputable, then there's a reasonable chance. I've actually been through that with getting a letter of intent in a contract from a government agency and then going and getting financing for it. So it does depend on the certainty, the security that the lender feels is involved in the transaction. If they feel that it's reasonably secure, then you may be able to find somebody a financial institution that will lend you money. If you haven't had experience delivering that product or service before, honestly, I think you'll have more difficulty doing it unless you can show the bank that you're very, very confident, uh, and they and convey to them your confidence that you'll be able to deliver it. Going through a projection like this, showing them that you can deliver it and make a profit, is what you're going to have to do. You still need this stuff in order to get that funding. Just a letter of intent by itself won't work.
Excellent. I was just going to make that point at the end if you didn't. So,
Right. Good.
yes. All right. That is all the questions I have, and we are right at 11 o'clock. So,
Okay.
thank you, Mike, for sharing your vast experience and knowledge. Thank you all for joining us, and I really hope to see you again on another workshop or the next business essential in this series. Thanks, everyone.
Great. Bye-bye.
Bye.